If you think this is just a price gap, you're already late, because this isn't a chart move and it's a door opening, and once it shuts, the people holding paper will be left outside. In a few hours, one market opens and the other market gets exposed. $18 per ounce is not normal. It's a signal that something underneath is cracking. And here's the terrifying part. This kind of gap is supposed to vanish in minutes, but it didn't. It stayed, and it got wider. So ask yourself, why would free money stay on the table? Unless someone can't deliver what they promised. Stay with me, because when this opens tonight, one headline will change everything, and most people won't even realize it happened. Now, welcome to Market Metal. My friend, if you're watching this and you're over 50, you already know this feeling, that quiet moment when history turns and the crowd is still sleeping. So do me a favor, subscribe like you're locking your front door before a storm, and turn the bell on so you don't miss the next warning. And tell me in the comments, where are you watching from today? The price signal that should not exist. On a quiet weekend, while most financial centers were closed and trading desks were running on reduced staff, a number began to circulate among commodity analysts. It was not a rumor, and it was not a dramatic headline from a television network. It was simply a price. In New York, silver had recently closed near one level. In Shanghai, the same metal was being quoted at a noticeably higher level after currency conversion. For a casual observer, this difference might have seemed small. For professionals who study global commodity flows, it was not small at all. It was unusual, and unusual price behavior in a large liquid market often signals that something deeper is happening beneath the surface. The global silver market is supposed to function as a connected system. Major exchanges in North America, Europe, and Asia are linked through banks, trading firms, logistics networks, and currency markets. When a price moves in one region, traders in another region usually react within minutes. This is how modern markets maintain balance. Information travels fast, capital moves quickly, and gaps are normally closed before they become meaningful. That is the theory taught in economics textbooks and used by institutions that manage large portfolios. However, the situation being discussed among analysts did not follow that pattern. The difference between the Western benchmark price and the Asian benchmark price was not closing quickly. It had remained open for several sessions. In some cases, reports suggested that the gap had widened instead of narrowing. For experienced market participants, this raised an important question. Why would a clear price difference persist in a market that is known for high liquidity and constant arbitrage activity? To understand the concern, it is important to explain what an arbitrage gap really represents. Arbitrage is not a speculative gamble. It is a mechanical process used by professional traders and institutions. When the same asset is priced differently in two locations, participants with access to both venues can buy where it is cheaper and sell where it is more expensive. The profit comes from the difference. Because many firms compete to capture that difference, the gap normally disappears quickly. This is one of the basic forces that keeps global prices aligned. In commodities such as oil, copper, and silver, arbitrage is supported by a large infrastructure. There are shipping routes, insurance contracts, warehouse systems, and financing arrangements that allow physical material to move from one region to another. Banks provide credit, trading houses manage logistics, exchanges oversee settlement. The entire structure exists so that price differences do not remain open for long periods. When a gap stays visible, it often suggests that one or more parts of this structure are under pressure. The business community tends to watch these signals closely because commodities are not just financial assets. They're inputs for real industries. Silver, for example, is used in electronics, energy systems, medical devices, and industrial manufacturing. If the price structure becomes unstable, companies that depend on predictable input costs can face planning problems. A manufacturer that budgets for one price may suddenly discover that the real replacement cost is higher. That type of surprise can affect margins, contracts, and long-term investment decisions. Another reason the gap attracted attention is that global price discovery depends on trust. Futures exchanges, spot markets, and physical dealers all contribute to a shared understanding of value. If one major pricing center begins to diverge from another, participants start to question which price truly reflects the availability of the physical metal. This is not a theoretical concern. In past commodity cycles, temporary splits between financial pricing and physical supply have created confusion for buyers and sellers alike. For younger entrepreneurs who are entering manufacturing, technology, or energy sectors, this may seem like a distant issue. Yet commodity pricing quietly influences many business models. The cost of solar equipment, electronic components, and specialized industrial tools can shift when key metals become scarce or difficult to source. When pricing signals become inconsistent across regions, it can indicate that supply chains are tightening or that demand is rising faster than expected. From a strategic perspective, a sustained price difference can mean several things. It might suggest that demand is stronger in one region due to industrial expansion. It could indicate that transportation or financing constraints are slowing the movement of material. It might also reflect policy or regulatory differences between jurisdictions. None of these explanations are dramatic on their own, but each points to friction inside a system that is normally smooth. Professional commodity analysts often describe markets as plumbing. And when the pipes are clear, flow is easy and prices stay aligned. When pressure builds somewhere in the system, small leaks appear first. Those leaks can show up as unusual spreads between exchanges. Over time, if the pressure is not relieved, the system may need adjustments such as higher prices, new supply, or changes in trading rules. Observers who understand this process do not react with panic, but they do pay close attention. Another factor that makes silver different from many financial assets is the role of physical settlement. While a large portion of daily trading volume exists in derivatives and contracts, the credibility of those contracts depends on the belief that delivery is possible if requested. Even if most participants never take delivery, the option must remain real. If market participants begin to doubt that physical supply is readily available at the quoted price, confidence in the benchmark can weaken. In global trade, confidence is a form of infrastructure just like ports or rail lines. When confidence is strong, transactions move smoothly. When confidence weakens, participants demand additional safeguards. They may request higher premiums, stricter contracts, or alternative suppliers. Over time, these adjustments can reshape how materials move between regions. For business leaders, recognizing early signs of changing confidence can provide valuable time to adapt sourcing strategies. The discussion around the silver price gap, therefore, was not about excitement or speculation. It was about interpretation. Analysts were asking whether the difference represented a short-term logistical issue or a deeper structural change in how the metal was being priced and distributed. In complex markets, early signals rarely provide complete answers. They simply indicate where attention should be focused. Historically, commodity markets have gone through periods where pricing centers competed for influence. Sometimes, the dominant benchmark shifted from one region to another as industrial demand moved. These transitions were rarely announced in advance. They became visible through patterns such as persistent premiums, unusual inventory movements, or changing trade flows. Participants who monitored these patterns were better prepared than those who relied only on headlines. At this stage, the most responsible conclusion was not that a crisis had begun, but that a signal had appeared. Signals do not predict outcomes with certainty. They highlight imbalances that may require correction. In efficient systems, corrections can happen through gradual price adjustments or increased supply. In more constrained systems, adjustments can be sharper and more disruptive. The task for serious decision makers is to observe without exaggeration and to prepare without overreacting. For the business community, the key lesson was simple. When a widely traded industrial metal shows a sustained difference between major global pricing centers, it deserves careful analysis. Such a divergence may reveal changes in demand patterns, supply availability, or market structure. Ignoring the signal can leave companies exposed to sudden cost shifts. Studying the signal can provide early insight into where pressure is building. As the new trading week approached, professionals across logistics firms, trading houses, and manufacturing companies were watching the same data. They were not looking for dramatic headlines. They were watching to see whether the gap would close as theory suggested, or whether it would persist long enough to confirm that something inside the global pricing mechanism was changing. In markets, small differences often carry large meaning. This was one of those moments when a simple number on a screen demanded more attention than usual. The mechanics behind cross-border commodity arbitrage. In the hours that followed the unusual price divergence, the attention of professional observers shifted from the number itself to the machinery that normally corrects such differences. In modern commodity markets, price gaps do not close by accident. They close because institutions are built to remove them. Trading firms, banks, logistics companies, and exchanges operate like a coordinated system whose primary function is to keep global prices aligned. When that system hesitates, even briefly, experienced participants begin to ask a deeper question: which part of the mechanism is slowing down? Cross-border commodity arbitrage is often described in simple terms, but in practice, it is a highly organized process. A large trading house does not simply notice a cheaper price in one location and act on instinct. It relies on pre-approved credit lines, secured warehouse access, shipping contracts, insurance coverage, and regulatory clearance. Every step must be confirmed before any physical material moves. The trade is only profitable if each link in that chain functions without delay. That is why persistent price gaps are unusual. Too many institutions have an incentive to close them. In a typical environment, once a spread appears between two major markets, several types of participants respond immediately. Proprietary trading desks run algorithms that scan for price differences across exchanges. Commodity merchants compare freight costs against potential profit. banks assess whether financing the movement of metal will produce a safe return. Within minutes, orders begin to flow. The cheaper market sees increased buying. The more expensive market sees additional selling. The spread tightens, often before the broader public becomes aware it ever existed. But the situation under discussion did not follow that script. The gap remained visible longer than expected. That alone suggested that at least one constraint was interfering with the normal correction process. In commodity logistics, constraints can appear in several forms. Physical inventory may be tied up in long-term contracts. Shipping capacity may be limited. Warehouses may require additional verification before releasing material. Currency conversion costs or capital controls can also slow transactions between jurisdictions. Each of these factors can create friction, and friction is the enemy of instant arbitrage. Another layer of complexity lies in the difference between financial exposure and physical possession. A large share of daily trading volume in metals occurs through futures contracts and other derivatives. These instruments allow participants to hedge price risk without moving actual bars. Under normal conditions, this structure improves efficiency because it reduces the need for constant transportation. However, when a price gap suggests that physical supply is more valuable in one region, participants may attempt to convert paper positions into deliverable metal. That transition, from financial claim to physical asset, takes time and depends on available inventory. For businesses that depend on predictable input costs, this distinction matters. A manufacturer might see a benchmark price on a screen and assume that metal can be sourced at that level. In reality, the price for immediate physical delivery can include premiums, waiting periods, or quantity limits. When spreads between regions persist, it often indicates that the physical market is tighter than the financial market suggests. Experienced procurement teams monitor these differences because they reveal early signs of supply pressure. Institutional arbitrage is also constrained by the rules of exchanges. Futures markets operate on standardized contracts with defined delivery windows. A trader cannot demand immediate shipment outside those terms. If many participants attempt to stand for delivery at once, warehouses must process requests in sequence. Even when metal is available, paperwork, inspection, and transfer procedures introduce delays. These delays can allow a price gap to remain open longer than theory predicts. Currency dynamics add another layer. When two markets operate in different currencies, traders must factor in exchange rates, hedging costs, and settlement timing. If volatility in the currency market increases, some firms may temporarily step back from arbitrage to avoid additional risk. This hesitation can widen spreads that would normally close quickly. From a distance, the gap appears irrational. Up close, it reflects the combined effect of multiple risk calculations happening simultaneously across institutions. There is also a strategic dimension that is rarely discussed outside professional circles. Large industrial buyers sometimes prioritize supply security over short-term price efficiency. If a region is expanding manufacturing capacity, firms may accept higher local prices to ensure consistent access to material. In such cases, the premium is not a mistake. It is a signal of urgency. Over time, sustained premiums can attract new supply routes, but that adjustment requires months, not hours. Logistics itself can become the critical bottleneck. Moving bulk metal across continents involves aircraft capacity, customs clearance, insurance documentation, and secure handling. Even when a trade is clearly profitable, the physical process cannot be accelerated beyond certain limits. During periods of heightened demand, cargo space becomes scarce and costs rise. These practical realities are often invisible on price charts, yet they determine how quickly markets can rebalance. From the perspective of young entrepreneurs entering industrial sectors, this is where theory meets reality. Markets are efficient most of the time, but they are never frictionless. Infrastructure, regulation, and human decision-making all introduce delays. When several delays occur at once, price differences can persist long enough to send a meaningful signal. That signal does not guarantee a crisis, but it does indicate that supply chains are operating closer to their limits. Professional risk managers pay attention to how long a spread remains open. A gap that closes within minutes is routine. A gap that survives multiple sessions suggests that participants are either unable or unwilling to commit capital to close it. In both cases, the implication is the same. The system's capacity to self-correct is under strain. Businesses that rely on stable inputs begin to review inventory levels, supplier contracts, and contingency plans. Another important factor is market confidence. Arbitrage depends on the assumption that delivery will occur as expected. If even a small group of participants begins to doubt the speed or reliability of settlement, they may demand additional verification before committing funds. This caution slows activity, which in turn allows spreads to remain visible longer. Confidence, once reduced, is restored gradually rather than instantly. As analysts continued to observe the divergence, their focus moved from speculation to process. They examined shipping data, warehouse reports, and trading volumes across sessions. The goal was not to predict a dramatic event, but to determine whether the plumbing of the market was functioning normally. In complex systems, small irregularities often appear before larger adjustments. Recognizing those irregularities early provides time to respond in a measured way. By the end of the observation period, one conclusion was becoming difficult to ignore. The persistent price difference was less about opportunity and more about constraint. Something within the chain, whether inventory availability, logistics capacity, regulatory friction, or strategic demand, was slowing the natural flow that usually keeps prices aligned. For decision makers in manufacturing, finance, and trade, that realization carried weight. It suggested that the issue was not a temporary misprint on a screen, but a signal that the physical movement of material was encountering resistance. In commodity markets, resistance rarely appears without consequence. It can lead to gradual price adjustments, shifts in sourcing strategies, or changes in how contracts are structured. None of these outcomes happen overnight, but they begin with the same early sign: a gap that should have closed, yet did not. Strategic demand. Why silver has become a geopolitical industrial metal. As analysts moved beyond the mechanics of arbitrage, their attention shifted to a deeper question. If a persistent price premium existed in one region, what kind of demand was strong enough to sustain it? In commodity markets, short-term speculation can create brief distortions, but sustained premiums usually point to structural forces. In the case of silver, those forces were increasingly tied to industry, technology, and long-term national strategy. Silver is often described as a precious metal, but in modern economics, it behaves more like a critical industrial input. Its physical properties, high electrical conductivity, thermal efficiency, and resistance to corrosion, make it difficult to replace in many advanced applications. It is used in electronic circuits, high-efficiency energy systems, specialized medical equipment, and precision manufacturing. As global economies continue to electrify and digitize, the metal quietly sits inside the infrastructure that supports daily life. For business leaders, this matters because industrial metals do not respond only to investor sentiment. They respond to production schedules, factory expansion, and government policy. When a country commits to building new energy capacity, expanding semiconductor manufacturing, or scaling advanced electronics, the demand for specific materials rises in a predictable way. Silver, in particular, is closely linked to solar technology, power management systems, and high-reliability connectors used in complex machinery. This connection between technology and material demand creates a strategic layer that is easy to overlook. Governments and large corporations do not always approach commodities as short-term trades. They often treat them as resources that must be secured years in advance. Strategic stockpiles, long-term supply contracts, and direct investment in mining operations are common tools used to reduce dependence on volatile markets. When such behavior intensifies, local prices can begin to reflect urgency rather than convenience. Observers of the Asian manufacturing sector had already noted that several industries were expanding capacity at a steady pace. Energy infrastructure projects, grid upgrades, and electronics production lines require consistent access to conductive metals. If domestic supply cannot meet those needs, imports become necessary. Over time, steady import demand can place upward pressure on regional prices, especially if suppliers elsewhere are slow to increase output. The structure of the silver supply chain adds another complication. Unlike some metals that are mined as primary products, a large portion of global silver production comes as a byproduct of mining for other materials such as copper, lead, or zinc. This means that increasing silver supply is not always a simple decision. Producers cannot instantly raise output unless the economics of the primary metal also support expansion. As a result, short-term supply tends to be relatively inelastic. When demand grows faster than supply can adjust, markets rely on inventories to absorb the difference. Warehouses, refineries, and dealers release stored material to maintain balance, but inventories are not infinite. If drawdowns continue for extended periods, participants begin to monitor stock levels more closely. Premiums in certain regions can emerge as buyers compete for available units. From a distance, this appears as a simple price difference. In reality, it reflects the tension between steady consumption and limited replenishment speed. There is also a geographic dimension to consider. Over the past decade, a significant portion of global manufacturing growth has been concentrated in regions that prioritize export-driven production. These regions require stable access to inputs to maintain output targets. When planners anticipate future shortages, they may encourage early procurement. Early procurement does not always make headlines, but it changes the flow of materials across trade routes. Historically, shifts in industrial geography have often been accompanied by shifts in commodity pricing power. When demand clusters around a specific manufacturing hub, suppliers gradually redirect shipments toward that hub. Over time, local benchmarks gain influence because they reflect where the material is actually being consumed. This process is rarely announced. It becomes visible through patterns such as persistent premiums, increased import volumes, and changes in inventory distribution. From the perspective of young entrepreneurs building businesses in technology, energy, or manufacturing, these patterns carry practical implications. Input costs may become more volatile. Lead times for specialized components can extend. Suppliers may introduce allocation policies that prioritize long-term partners. Companies that monitor material trends early can adjust procurement strategies before constraints become severe. Another element increasing the strategic value of silver is its role in energy transition projects. High-efficiency solar panels require conductive pastes that rely on silver content. Grid modernization efforts depend on reliable electrical connections. As nations pursue energy diversification, demand for conductive metals tends to rise alongside installation targets. Even incremental increases across many projects can translate into significant aggregate consumption. Industrial users often think in terms of continuity rather than price alone. A factory line that stops due to material shortage can cost far more than paying a moderate premium for guaranteed supply. This mindset can support higher regional prices without triggering immediate substitution. While research into alternative materials continues, many applications still depend on silver's specific properties, limiting short-term flexibility. In parallel, financial participants observe these developments because sustained industrial demand can alter long-term valuation frameworks. When a commodity transitions from being primarily investment-driven to being heavily consumption-driven, price behavior changes. Volatility may increase during supply disruptions, and regional differences can become more pronounced. Markets begin to reflect the realities of physical movement rather than purely financial positioning. The emerging picture, therefore, was not one of sudden excitement, but of gradual strategic accumulation. If a region is expanding manufacturing capacity while global supply growth remains constrained, local buyers may accept higher prices to secure reliable access. Over time, this behavior can reinforce itself. Suppliers notice the consistent demand and prioritize shipments accordingly, which further strengthens the regional benchmark. For decision makers, the most important insight was that the observed premium could not be understood solely through short-term trading activity. It had to be viewed through the lens of industrial policy, supply chain structure, and long-term resource planning. Markets often reveal strategic priorities through pricing signals before official statements confirm them. As analysts compared trade flows, production data, and inventory trends, a cautious narrative began to form. The divergence in pricing might reflect more than temporary logistics friction. It could be a sign that the center of gravity for certain industrial metals was gradually shifting toward the regions where manufacturing demand was most concentrated. Such shifts do not occur overnight, but once underway, they can redefine how global benchmarks are interpreted. In that context, the persistent premium carried a quiet but powerful message. It suggested that silver was being valued not only as a tradable asset, but as a strategic component of future infrastructure. For businesses planning long investment cycles, recognizing that shift early could influence sourcing decisions, partnership strategies, and capital allocation. Markets rarely announce structural change with certainty. They hint at it through patterns that reward those who are attentive enough to notice them. Systemic risk scenarios for financial markets. By the time the price divergence had persisted across multiple sessions, the discussion among serious observers shifted from mechanics and demand to a more difficult subject: system risk. Not the dramatic kind that appears suddenly on headlines, but the quiet, structural risk that builds when the signals inside a market stop aligning with each other. In commodity systems, the most important signal is trust. Trust that a quoted price represents something that can actually be obtained when needed. Futures exchanges, spot dealers, refiners, and logistics networks operate on that shared assumption. A company may never intend to take delivery of metal, yet it still relies on the belief that delivery is possible. This belief is what allows contracts to function as reliable hedging tools. When participants begin to question whether the quoted benchmark reflects real availability, behavior changes. Hedgers become cautious. Traders demand wider margins of safety. Suppliers renegotiate terms. The system does not fail overnight, but its efficiency begins to slow. The persistent spread between regional prices therefore introduced a sensitive question for institutions. Which benchmark should guide decisions? If one pricing center reflects financial liquidity and another reflects immediate physical demand, companies must decide which signal is more relevant to their operations. For manufacturers that depend on consistent supply, the physical signal often carries greater weight. For financial portfolios that rely on derivatives, the paper benchmark may still dominate. When these two references drift apart, planning becomes more complex. Historically, commodity markets have experienced moments when confidence in settlement procedures was tested. In such periods, exchanges sometimes adjusted margin requirements, tightened position limits, or modified delivery rules to stabilize trading conditions. These actions were not necessarily signs of failure. They were attempts to preserve orderly markets. However, each adjustment also reminded participants that rules can evolve when stress increases. Businesses that rely heavily on a single benchmark learn to diversify their sources of information. One potential outcome of prolonged divergence is the emergence of a two-tier pricing environment. In this structure, financial contracts continue to trade actively at one level while physical transactions occur at another. The difference may be explained by storage costs, transport delays, or regional demand. Over time, if the gap remains wide, participants begin to reference both numbers simultaneously. Procurement teams might track the exchange price for hedging while negotiating physical premiums with suppliers. This dual framework adds complexity, but also provides a more realistic picture of actual costs. For entrepreneurs entering manufacturing or technology sectors, such a shift can have practical consequences. Budget forecasts based solely on benchmark prices may underestimate replacement costs. Inventory strategies may need to become more conservative. Companies may choose to hold additional stock as a buffer against delivery delays. These decisions increase short-term expenses, but reduce the risk of production interruptions. In competitive industries, continuity often matters more than marginal savings. Another scenario involves gradual price convergence through higher global benchmarks. If sustained regional demand continues to draw material towards specific manufacturing hubs, suppliers may redirect shipments until prices rise elsewhere to match. This process is not instantaneous because mining output cannot expand quickly. Instead, prices adjust over several cycles as buyers compete for limited supply. Businesses that monitor these shifts early can renegotiate contracts or explore alternative materials before costs escalate further. Financial institutions also face adjustments when physical signals begin to dominate market narratives. Risk models that rely heavily on historical correlations may require recalibration. Hedging strategies based on narrow spreads may become less effective. Portfolio managers may increase exposure to real assets or diversify across multiple commodity inputs. None of these actions are dramatic on their own, yet together they indicate a shift in how participants perceive underlying stability. A more subtle risk involves information asymmetry. Large industrial consumers and global trading houses often have better visibility into inventory levels and shipping flows than smaller firms. When pricing signals diverge, those with deeper data can react earlier, securing supply or adjusting positions before broader markets respond. For emerging businesses, the lesson is not to compete on scale, but to compete on awareness, tracking supplier communications, monitoring lead times, and maintaining relationships that provide early warning of tightening conditions. There is also a strategic dimension tied to national resource planning. Governments that view certain materials as essential for energy or technology development may encourage domestic firms to prioritize secure access over lowest cost. This approach can reinforce regional premiums without any explicit policy announcement. Over time, such behavior reshapes trade routes and influences which pricing centers gain authority. Businesses operating internationally must remain attentive to these quiet policy signals because they affect long-term sourcing reliability. If confidence in a benchmark weakens significantly, participants may gradually shift toward alternative reference points. This does not happen through a single decision. It occurs through many small choices: contracts written with different clauses, suppliers quoting different bases, analysts publishing research that emphasizes new data sources. Eventually, the market recognizes a new center of gravity. These transitions are rare, but not unprecedented in commodity history. For decision makers, the essential takeaway is not to predict a dramatic event, but to recognize that persistent divergence is a form of feedback. It indicates that the system is adjusting to new pressures, whether those pressures come from industrial demand, logistics constraints, or strategic accumulation. Ignoring the feedback can leave organizations exposed to sudden cost changes. Responding thoughtfully allows time to adapt procurement, pricing, and investment strategies. As the next trading sessions approached, professionals across industries were not waiting for a headline to confirm their concerns. They were reviewing supplier agreements, checking inventory coverage, and stress testing budgets against higher input costs. These are quiet actions, rarely visible outside boardrooms, yet they represent the practical response to uncertainty. Markets often change direction long before public narratives catch up. In the end, the persistent price gap served less as a prediction and more as a signal, an indication that the relationship between financial pricing and physical availability was under review by the market itself. Whether the adjustment would come through higher global prices, increased supply, or new trading norms remained uncertain. What was clear was that serious participants were paying attention, not because of excitement, but because small structural shifts can influence large economic outcomes over time. For businesses, entrepreneurs, and investors alike, the moment called for discipline rather than urgency. Monitor multiple benchmarks, maintain flexible sourcing, avoid relying on a single price as the definitive truth. Commodity markets rarely send clear warnings, but when they do, those warnings appear as quiet inconsistencies, numbers that do not behave the way they usually do. Recognizing those inconsistencies early is often the difference between reacting late and preparing in advance.